move into our next investor-led panel discussion of the afternoon. And we'll be focusing on the appetite for exploration. There were a few mentions of it this morning. It's a very interesting theme, very topical. And so I'd like to invite our panelists to the stage. First, Greg Johnson of Group 10 Metals. Greg's the executive chairman there. Mike Patterson, investment associate of the deal team at Resource Capital Funds. Kevin Fox, managing director at Rio Tinto Ventures, and Matthew Piggott, head of research at S&P Global. So, gentlemen, if you could join me up on the stage here. Yeah, any order, please. So look, we've got a fantastic selection and a range of experience on the panel here. And what I'd like to do is, we're currently without Greg, but I'm sure he's on his way. I'd like to sort of set the scene a little bit for what we're looking at with global exploration trends. And we were chatting just before this, and Matthew's got some fantastic research that S&P have been doing, and some interesting takes on the themes that are going across world exploration. So Matthew, if I'd just like to introduce yourself, and then, of course, take us through some of the themes that you're seeing across exploration at the moment.
Yeah, sure. So, yes, I'm Matthew Piggott. I'm the head of research for metals and mining at S&P Global Market Intelligence. Quite a lot of the work that we've been doing on the exploration sector has been to collate a lot of numbers, scrape an inordinate amount of data, and we conduct an annual survey of over 3,000 companies in the sector. And from that, we estimate annual company exploration budgets and look to see where companies are spending that money and on what types of property they're spending that money and what commodities. So in 2017, what we saw was sort of the first annual uptick in exploration expenditure for several years. So there was about $8.4 billion spent on exploration for non-ferrous metals in 2017. That represented a 15% rise in exploration expenditure. This followed successive years of decline since 2012, where industry exploration has kind of tracked down very heavily in line with commodity prices. And that could be construed as a good result, and that the industry is turning the corner, and a few other data points would seem to support that. So in 2016, around March, there was a large uptick in the amount of equity financings that were coming to the market, with a more than sort of doubling of the monthly volumes of money being raised by intermediate and junior companies. Coupled with that, 6 months later, you saw an uptick in the number of projects being actively drilled in any single 1 month. So we had project levels, sort of 150 to 200 projects being drilled every single month, to moving up to sort of close to 200 to 250 active projects every month. And in terms of the number of drill holes being actually fired up every single month, that was shown a strong trend of increase since those financing started to come through. Now, that all sounds sort of more like green shoots for the sector, and that we could be on the way for an exploration-led market going forwards. But there are a couple of things to be cognizant of that I think we should raise. And the first is the level of money that went into exploration expenditure last year was, still 2/3 down from where we were in 2012. And that's, when over $22 billion in money of the day was committed to exploration. And secondly, that the level of financing and the level of drilling going on the ground is actually still lagging where we were back in 2012 as well. So after several years of a trough, we have still not really come back to where we need to be in order to find the projects of the future.
And do you have any idea or any sort of findings as to why that might be? We'll ask the panel later, but is there anything S&P sort of would attribute that to? Is it cyclical, or are we?
Yeah, so there's an alarming trend has happened in that a lot of the spend that has been happening has been slowly moving away from the junior sector. So while the absolute volume of dollars that's coming back to exploration has risen in 2017, we expect the volume of dollars to rise again by about 20% in 2018 when we collate the numbers, but that will still only leave us at around $10 billion. And for the last 2 years, the majority of the spend that's been occurring has actually been allocated to sort of major mining companies, and the juniors' share of exploration has shrunk to sort of an all-time low. So that's within the sort of rough 28 years that we've been collating the budget. So money has steadily been moving away from being spent by the juniors and moving into the hands of the majors, and I think that follows a trend of industry de-risking since commodity prices began falling. And secondly, that's kind of reinforced with the trend of de-risking, whereby the dollars that are being spent, and being spent by the majors in particular, are all going to existing operating mine sites. So it's on-mine exploration expenditure, and less being allocated to the sort of grassroots side of the industry, where the percentage allocations have actually shrunk to multiple year lows. So we're not in a good place around the amount of money that's flowing into the junior end of the industry, and I think we're still stuck in a phase of de-risking, where I think that in order for more supply to come to the market for the long-term projects of the future, in say 5-10 years time, the real grassroots stuff, I feel that we need to see a little bit of increase in risk appetite.
Sure. Craig, you've just joined us, and we've only just spoken with Matthew so far. But what's your sort of take on that from the miner's perspective? And at the junior end, you've obviously got a very good experience working across the whole spectrum of mining companies. But what's your take on that financing situation at the moment?
Yeah, even though we've seen what appears to have been the low put in for metal prices, we have not seen the funds coming back into the juniors. It continues to be a very difficult financing market for most companies. Many of the companies are becoming creative with how do they reduce their costs, how do they spread out their focus. We've seen a lot of the prospect generator type models develop. People are doing everything they can to keep high quality explorationists in the field, but with a lack of funds that are focusing on the earlier stage exploration where the discoveries are often made. I'd be interested to know the stats in terms of discovery figures, but I think anecdotally we think in the industry most of the grassroots discoveries tend to be by the juniors. If that junior sector is not getting funded, that would support why perhaps we're seeing fewer discoveries made this decade than in past. And I think the industry needs to maybe perhaps rethink how do we fund these earlier stage. They are higher risk, they tend to be lower market cap companies. So are there other structures that funds could take to approach how do we get money into this part of the industry that tends to make discoveries, and where those experienced explorationists are residing in terms of the future of setting the stage for new mines down the road.
And do you find there's a geological risk that investors perhaps aren't quite trusting at the exploration stage at the moment? Or do you find it's more around the financing models not supporting exploration?
Well, yeah, I think we've just come out of a bear market for 6 months in the sector. So any investor who's been in this sector for more than a couple of years has been really beaten up. So I think it's a sector that's not performed if we look at a 2, 3, 4 year horizon. There's been other sectors that have been taking the limelight, if you will, in terms of speculative capital. I think that plays a role. So I don't think it's been risk per se, although there have been some horror stories about third world jurisdictions where mines have been expropriated and things, and that pops up from time to time. But I think at this point it probably reflects the cyclicity of our sector, and the fact that we go through these big highs and then down through these extreme lows. And we believe, a lot of analysts believe, that we've probably passed the low point, and so it's the beginnings of a new cycle. But that performance, especially over a multi-year basis, isn't there yet to prove that kind of perspective.
So we're still sort of clawing on to some extent. Excellent. Kevin, I'd like to bring you in here just to sort of get a take on, firstly, your unique role with Rio Tinto Ventures. If you could sort of tell us about how you're positioned, and then we can get the view from the financing side or the investment side. What's the sort of advantages that you have with Rio Tinto Ventures compared to the big Rio business, and also how are you looking to sort of do you see any opportunities in this exploration environment that we're in at the moment?
Thank you. Firstly, I'd say Rio Tinto Ventures has been going just over a year now, and the driver to establish what is a small group of us here in London was primarily to give Rio Tinto another arm to its growth strategy. Like most of the majors, I think we're back in territory now where we're prepared to contemplate growth, and as the two speakers before me alluded to, the exploration space is not full of wonderful opportunities at the moment, and we recognise that. And while we are concerned by it, what we have decided to do in Ventures is to put ourselves out there as a group that is part of the larger Rio Tinto, obviously, and has access to the resources, both technical and financial, of the Rio Tinto group. And I think that's one of the points that would distinguish us from perhaps some other alternatives for financing. With a view to taking on projects, certainly at the PFS stage and beyond. I don't think we view ourselves as the group that would be going back to the early stage grassroots exploration. We have RTX, which is our exploration group, which is a worldwide organisation and has presence in many countries on the ground, and we work very closely with RTX to make sure that we're aware of opportunities emerging in all parts of the world and across the commodities sector. I think the view that we're taking at the moment is that we will confine ourselves to PFS and beyond. It just makes sense for us when we're looking at investing in developing projects. We like to have some ability to get a handle on the resource potential, the first stage view as to the economics of a project and the potential. And I guess in particular what we are very keen to identify is projects that have upside in terms of resource, but perhaps lack the resources, technical and financial, to fully develop those. And we'd like to think that's what we could bring to projects. So in that regard, while not, as I said, going back to the early stage of grassroots exploration, we are certainly prepared to take on projects with a view to trying to move them forward. In particular, look at the upside, i.e. a bigger cake and a slice of it.
And how hands-on are you in that process? You're very much embedded with the management teams. Yeah.
We are, and as I said, we have obviously strong contacts with our exploration group, also with our projects group, and have access to a wide range of technical resources that we can bring to bear to companies. So our objective is to work collaboratively with the management of projects, companies that we see as having appropriate level of attraction for us, and yes, work together to develop the upside potential.
Fantastic. Mike, I'd like to get your take on this. How does exploration sit with RCF at the moment? Obviously, huge PE firm, global presence, many projects all over the world. What's the take from your side?
Yeah, thanks. So Mike Patterson, I've been with RCF about 4.5 years. Before that, I'm a mining engineer by background, now talking about exploration. So I'm a bit in over my head sometimes, but I'm working on it. So at RCF, as we grew, we started moving towards a sort of style that a lot of other PE funds are doing, which was slightly more risk off. We wanted to be able to tick more boxes as these projects were increasing in their stage. So wanting to go out and build new mills and that sort of thing. But what we realized is that at doing that, we were missing out on really somewhat of our roots as a firm, and then missing out on a lot of opportunity right now, which is in the exploration space, we believe. So I'm on a team investing a fund that's dedicated to effectively earlier stage, but really our mandate's broad enough that We can go from sort of grassroots all the way through to pre-fees and later. And we really are seeing a lot of opportunity in the early stage space. Interestingly enough, as Greg mentioned, a big piece that we're seeing change is the prospect or project generator model. Years ago, there were maybe a handful because it was a bit of a taboo thing to say. Everybody wanted to be a part of an exploration company going out and doing the work themselves. But because capital has been very hard to come by, someone that fires up a prospect generator can bring on a couple of sharp geologists and go find a lot of land. And then bring in these JV partners to help fund these things rather than a sort of sole institutional funder. And then the obvious JV partner is the likes of Rio and Barrick and whomever else. Another interesting trend that we're starting to see now and coming off of sort of the lows in exploration spending is that the majors are definitely starting to tap back into the juniors. We're seeing a lot more of the big guys coming in and either taking direct equity stakes in the companies themselves, coming up to that 9.9 threshold, or going straight through it and pushing the sort of 20% numbers. Or there's a lot of JV agreements happening between the juniors, and so I think the majors are starting to put the money back out there, and they are getting in. But overall, our industry is starved for capital. That's for sure. And definitely on the exploration side. So the sort of rocket ship that I think a lot of people were hoping was going to show up and bring us off the bottom never came. Is really this sort of round bottom, slow recovery that we're coming through over the last couple of years. But when everybody was doom and gloom and low valuations a couple of years ago, especially on the exploration space, they couldn't raise any money. Valuations are down. Now. It's quite similar on the valuation side. The market caps haven't really come up that much, and money is still hard to come by. So from our standpoint, it's a very exciting time, just as it was a couple of years ago from the investor side. And now we do have the means to directly help support some of these junior companies. And so it's a great time for us. But obviously, depending on what side of the aisle you're standing on, it may not always feel that way.
And what does the sort of process look like when you are working with these companies, these explorers? Are you very much a patient capital approach? Do you have a sort of set timeline in which you need this return on? What does an exit look like for you guys?
Yeah, so similar to the broader RCF and all of our past funds, private equity in generally are closed-end funds, so there is a set horizon. But what comes with that is that you do find that patient capital, that you do find investors that are willing to stay with the company for years on end. What we're seeing is generally we're mining folks by background. We have a lot of mining expertise in house. We have a very large technical team who are all mining folks by background. And we understand the issues with exploration. There's things come up. At the end of the day, it's Mother Nature, and you can't really beat her. So we understand that things aren't always going to go to plan, and we go in with a very eyes wide open approach to that. That being said, because of the exploration, the extra risks that we're taking with those investments, that we'd hope to be able to take advantage of some of the volatility that comes along with it, and bring money off the table a bit sooner than sort of conventional private equity may be willing to keep extremely patient capital. But we are able to adapt, and if that means tranching out the investments and showing continued support over a matter of number of years, that's something that we're definitely willing to do. And I think you need those disciplined investors who are able to supply that patient capital at least for some number of years to see the strategy through, especially with some of the harsh environments and then that sort of thing. It definitely doesn't always go to plan.
Sure. Kevin, how does that sort of differ from your approach to looking for an exit? Is the nature of the business model to sort of feed into the bigger beast that is Rio, or are you? How does it work from your side?
Yeah, so as I said, I mean, the objective of ventures really is to contribute to the growth of Rio Tinto. And I should say part of the subsidiary motivation for development of the ventures group was to broaden our exposure to commodities that we don't currently have a presence in. So that is an important part of our strategy. As regards, are we in forever? I think not necessarily. I mean, we have a mandate to look at growth opportunities that will contribute to Rio Tinto, both financially and from the commodity supply perspective of commodities of interest to us. So, no, we don't necessarily say we have to be there forever. There is opportunities for us to look at making an investment that makes sense and then looking at who is the logical owner from a point.
And what are some of these commodities that you're looking at now? They're some of the fresher new commodities.
I mean, I think it's probably trite to say that, the battery mineral sector is one that is attracting a lot of interest, and, we are obviously looking at that. But I would say, we include in that now copper, of course, and, I think it's well known that the supply of high-quality copper opportunities of interest to a company like ourselves is fairly limited. But, ditto, I would say the same about nickel and, as was alluded to earlier, cobalt, for example, is a commodity that we'd all like to get our hands on, but there's not too many places to go, certainly in jurisdictional terms, that we would consider doable.
Sure. Look, we've got about nearly just under 10 minutes left. I'd like to open up to any questions from the floor. We've got a great panel up here. Has anyone got any pressing questions that they'd like to put, please, in the middle?
What's your view on looking at private companies that are re-advancing projects well versus some small companies that are actually, struggling, constantly coming back to the market? Do you favour private companies if they've got the real project?
Anyone like to take that?
So on our side, we're quite happy to invest in private or public. As you mentioned, we see a lot of these private companies that are coming out of the gates, and right now, especially through their IPO and or RTO process, they're raising these tiny dollar amounts to do their sort of initial exploration programs. And you raise $500,000 or $1 million, it gets you 6 months down the road, and then you start coming back to the market over and over. And it's generally a destructive process. So, we definitely are okay with private companies, and a lot of times, our capital is patient enough that we're happy for a company to stay private, get, quite a bit of work done, and then hit the market with something, tangible, or close to tangible. So, I completely agree, and I think it's an issue that a lot of companies are struggling with.
Anyone else care to add?
From a slightly different perspective, the one thing that I would add is that we have had an increasing number of requests from our client base for private company data, which maybe isn't directly answering the question, but it does show the same kind of trend. And the use case for that is to be screening for opportunity generation across multiple sectors. So not just a mining sector trend, but there is that undercurrent of theme there out where people are seeking out opportunities in the private sector rather than the stuff that is much more visible to the masses.
Any further comments on that?
I just echo the two previous speakers. I mean, we take a view that it's the quality of the opportunity really that makes sense for us. It does obviously create an interesting dynamic for valuation when you don't have the quoted company to look at. But, as I said, it's primarily the quality of the opportunity that drives our interest.
Sure.
Yeah, and I might just add as the one issuer here, we have these discussions oftentimes, with such a, particularly if we look back to 2015 and a little before that, should you just take it private? It's so difficult to raise money. But many investors reinforce the fact that liquidity exit is important to them. So I think it's always this balance. I think we're going to swing through different cycles, but most investors like the idea of being able to put money in, and if their thesis changes or they've got what they wanted to in a return, that they can have a public market exit. So I think most of the companies I don't know what the numbers would be, but I think the vast majority that are exploring are still dominantly publicly listed, somewhere as the main trend. So.
Okay, any further questions for the panel? Yep, Jamie?
Thanks. A bit of an open question, but I think everybody seems to agree that financing of exploration companies needs to change, but it seems to be a bit of an open debate as to how they change. If crowdfunding is clearly not on the agenda at the moment, although there seems to be some sense for crowdfunding to do so, then is project generation the way ahead? And given the fact that the knowledge is in the geologists and the experts in that area who can fit into the project generators, and also on the other side, the capital is going into the strategics and the alternative lending, the alternative equity. Is project generation the way ahead, and who should we follow behind that?
I can't give you a recommendation on who to follow, but a name that comes to mind who's been very successful is Mirasol. 100+ million market cap. They have a plethora of projects under option, and they're obviously doing very well. One struggle that we have with the prospect or project generator model is that from an investor side, on the equity side, it's generally a very destructive model to the equity because there's so many JV arrangements, and then each of those projects gets pieced out, and then the company ultimately gets pieced out by each of the projects. That it is a difficult model to be successful with. So if your aim is to find projects and build those projects up and vend them out to majors, I think it's a model that obviously needs to have a strong look at. But right now, the way a lot of them are managed, it's very difficult. You look at the sort of 50 or so prospect generators that are out there, the vast majority are sort of in the sub 10 million market cap, and they've kind of just hovered around there. They start off in the very micro cap space, 1-2 million, they find a couple projects, they vend them, and they grow to 5 million or 10 million. But the groups that get sort of north of that 50 and 100 million market cap it's very slim. There's a couple, about 4 of them. So. And then beyond that, the company basically, if they find one great project, they sell it off, and then the company disappears. So the really awesome discoveries, those raw, exciting, things that gets everybody jacked up in the industry, those discoveries get vended off, and then the company disappears. So there hasn't been one of these things that keeps finding great discoveries, at least that I'm aware of.
And I would add one of the drawbacks of the prospector generator model is it almost requires that you option out or enter into a JV very early before you really know what you have. So for you, the equity investor, you've already kind of capped your upside. If a major has the right to earn 75% and you're left with 25, it could be the most spectacular discovery ever, but you've negotiated that entry, you know what the price is, it's already fixed. So you're gonna get a minority interest participation or a royalty even in something. And I think a lot of the market is looking for that, well, I want a 5X, where do I go out and get something that really gives me a bang for the buck? What we're doing at the Metallic Group, which is a bit of a hybrid, I guess, is we formed a management team that's got long-term industry expertise. We're setting up individual companies that are focused in metals. So for instance, we have a high-grade silver-focused company called Metallic Minerals. We've got a platinum nickel-focused company called Group 10 Metals. And we're going to be launching a copper company here later this year. Each one of those is a standalone public company. It's got strong corporate governance at the top. They're separate companies, but they're strong assets that are in each one, 100% owned brownfield districts properties. So in a way, what we're trying to create here is similar to a prospect generator, where when you look at the Metallic Group, you're looking at a number of different opportunities, but it allows the investor to choose either their metal or their team and go for that to try to give that kind of best of both. Why have them kind of together in that kind of structure? We can save cost. We can share technical expertise between the groups that you wouldn't otherwise be able to have as an individual company. We can have a small accounting team that services all of the companies. And so it's really trying to maximize dollars in the ground, potential for discovery. And the other wrinkle that we put is we're only going to explore in brownfields areas. We're going to explore in areas where mines have been found, risks are lower, roads are in place. power is in place. So it's just another example of kind of variation on the theme, but I think we may see others, undertaking that, and there's other groups like Hunter Dickinson and the Strategic Group, for instance, that are doing a similar type of approach as well. But another one to kind of think about in terms of when you're looking for quality names in the sector.
Okay, now we've got about a minute left. I just want to quickly get a slightly final take on this. Matthew, if you'd have looked short to mid-term, we've heard situation's not great, but equally there's still money around through various different financing models. How do you see the world picture over the next short to mid-term?
I think over the immediate term, the next 1 or 2 years, there are projects that have been explored and discovered in the past that have made it through that sort of 10, 15 year from inception through to development and then production, right? So we have enough material in the short term. So plenty of commodities have got enough supply coming on stream in terms of rising demand. We're not seeing peak commodity for many things, but it's when you move out past a 5-year time frame and you think that we've had what I consider to be 6 years of underinvestment in exploration of various kinds, and there is a lot of exploration still going on, and there's always funding available for quality projects, but I think longer term we're going to see the effects coming downstream from now in about 10 years' time. So 8, 10, 12 years' time, you'll start to see that coming through to the supply pipelines, that there's nothing being found right now at inception that is going to make it through.
Okay, interesting. Guys, on the investment side, dry powder for the rest of the year, or many more deals to be done? Are we very optimistic?
Yes, we're optimistic.
Fantastic.
I can't disclose anything else.
Sure. We'll just we'll end on a positive note then. Very good. All right, that's it, guys. A round of applause for our panel. Thank you very much.